That's what after there.
Okay, everyone, we have the distinct pleasure of speaking to my buddy from Canada, Adam Button. Adam at FX_Button at Forex Live. I'd like to open it up, my friend, with how's your better half? How's married life? And I'm not talking about Greg Michalowski.
Oh, Greg's gonna love that. Yeah. I'm married. I'm happy. Yeah, I got the ring and baby on the way. So busy times here. Cold days up in Canada. Hot for the Canadian dollar though today. Yeah, life's good. Life's good. How's things in sunny San Diego?
Warm, actually, in the 80s. So, you know, we haven't gotten as much rain as I thought we'd get from El Nino. But, you know, it's still February. It could still happen. Interesting action, Adam. I know that for the longest time you've, maintained this belief that the euro still is in a bear market, and we had this recent action to clean out crowded euro bear shorts over 109.60, 110.80. We're trading around the 113 range right now. Are you viewing this as a potential shorting opportunity in the euro, buying opportunity in the dollar?
Yeah, it's always the timing, as always. I mean, just now we're just putting up that Goldman Sachs stopped out of all their dollar long position that's against the euro, against the yen. I think it's everything that's crowded is heading to the sidelines now. You see all the momentum trades in stocks, Netflix, Amazon, Facebook, Google. You're getting cleared out and going to the sidelines, and then you get the market balanced once again. And today we see J.P. Morgan talking about the ECB cutting deposit rate to negative 70 basis points. That's that's a straight shot on a euro short. Deutsche Bank down $13 from 30 a few months ago. Worries about all kinds of problems at Deutsche Bank and other European banks. Whatever happens in the global economy, it's not going to be a U.S. only problem. It's just a bit of a reckoning and a squaring here before we get to the next leg of everything, and that we'll see in the commodity currencies again as well today.
Yeah, what is a bit terrifying about Deutsche Bank is it's back to crisis levels from 2008, underneath those levels. And so to me, our banking index is not as weak. Last time we were the epicenter and the catalyst, to me it looks like America's going to get pneumonia by catching a cold from China and Europe this time. Is that the way you're seeing it?
I love the expression, and I know you love the axioms. The one is generals always fight the last war, and the meaning of that is, general uses tactics that he would have used last time if he could redo it. And I think that's starting to be what's happening in markets. So you have commodity, right? To me, the story is the commodity collapse. China. Demand's maybe a touch softer. I don't see the problems in China that others are seeing. The Fed is so focused on it, I think they're wrong. The story to me is the collapse in commodities. And, that's not going to hit China so much as it does, if you add up Brazil, Saudi Arabia, Canada, Australia, Malaysia, all these economies, it's as big or bigger of an economy than China. It's bigger than the U.S. if you toss in a few more. And those
Europe is as well.
Sorry?
Europe is, the EU is as well.
Yeah. Well, just take the commodity exporters, for instance, and that you have a recession in, say, all those countries. A place like Brazil is having a severe recession, for instance. That's a very large economy, and so where does it go from there? We know that. I think that's priced in. It goes. So the thinking is that it goes to the financials, right? That's always the conduit, but that's also the thinking from the last. We're using the same playbook as the last war. And maybe it's not Deutsche Bank holding on, maybe it's Canadian banks, or maybe it's pension funds, some pension funds we don't know, or maybe it's mom and pop investors that are holding all these junk bonds. I think there's a bit of a risk that we're focused in financials. It's so opaque, right? We know that it's just impossible for me or anyone to say, well, what's on. The CEO comes out today and says we're rock solid. Shares go up 5%. Well, we're 10% down since earlier today in Deutsche Bank. The market's voting. But this is the kind of time when the market can really start to get skewed, as everybody looks for safety. But maybe we should just be looking for safety for now.
Well, what do you make out of gold up until recently really not getting any support from a weaker dollar until last week, or that one little that hiccup in March from Draghi? Gold advancing and a lot of money flow going into gold. You view this as a possible turn in the gold, because I think a lot of people are going to be calling this a bear market rally all the way to $1,400–$1,500.
Yeah, well, you read my mind. That has been the trade of the year so far, and not just because it's up, whatever gold's up $100 since the start of the year, but the volatility hasn't been there, right? And that's attractive as well. I mean, it's one thing to make money. I mean, the dollar CAD longs, I mean, it was up 10 cents, but then down 9 cents. I mean, that's a tough way to make 1 cent. Whereas gold, it's been 7 or 8 days in a row now. Really since the start of the year, a nice steady uptrend, and that's the kind of thing that brings in, we got to buy and hold, and then you get the momentum, and it goes and goes. People don't believe it. They mock the gold bugs. I mock the gold bugs, but I came in at the start of January, and gold seasonals in January are fantastic, and that proved once again this year that it was the best month for gold. So we started off great. And it's held up very well here. Chinese New Year, you should get a little bit less buying, but you get a weaker dollar. I mean, gold too, I think it gets tossed in with commodities, right? And the problem with commodities is oversupply. People talk about demand, slowing demand in China, but it's oversupply for me is the story. Back in 2007, 2011, 2012. All through then, you had nickel, for instance. Yesterday, nickel hit a 12-year low. You had nickel trading at $50,000 a ton. I mean, we're $8,000 a ton now. And all that money that went in investing in all these mines, well, they assume, maybe it might not be 50, it'd be probably still break even at 10 or 15,000. And now, the money came in, the debt was cheap, they supply, you build, and now you have a mine that's up and running. It's difficult just to shut it down, because all the investment's up front. So you just have supply coming in. It's the same in oil. It's the same in everything. And I think gold's been tossed into that as well. But remember, gold peaked a long time ago now. Production. Yeah, the production has slowed down since then. I mean, Barrick Gold, the biggest gold company in the world, shut down their operations in Chile. It was supposed to be the world's biggest gold mine. They shut that down over a year ago. The gold miners have taken that supply hit. They're not producing as much, and at the same time, gold is much easier to store than something like nickel or copper or certainly oil. So,
well, how about gold? How about once you shut down a gold mine or a silver mine, that it's much more difficult to ramp up production again from that mine than it is to turn on a fracking well?
Yeah, absolutely. And it's tougher to raise the money now. And I think it's going to happen in all commodities. The classic boom-bust cycle. Everyone thinks oil is going to be at 100 forever. Every project makes sense at 100. But at 30, it doesn't make any sense. But the money goes in, and then there's a lag, and then you get production. And gold is just a little bit ahead of that curve. And gold is different, from other commodities. It's a commodity in a lot of ways. It's been thrown into the pile with everything else. And I think that's kept it artificially low a little long. And I am starting to believe that 14, 15, 2000, it's in sight. The technicals, there's a bit of a downtrend at 1205. That's the near-term level to watch. But I've been bullish in that, growing increasingly bullish. We're talking about ECB at negative rates, the Fed cutting, back down to zero, Japan negative, Canada cutting to negative. Gold, Japanese 10-year bonds are negative today. So if you're not going to get any yield, you might as well not get any.
So there's more opportunity cost in cash than there is not receiving anything on gold.
Yeah,
even storage is more attractive than paying the bank to hold your funds.
I think gold's very easy to store, and it's scary.
Where do you hide yours?
Yeah, I know a guy. Under his kitchen floor, he has like a hidden thing under the linoleum in his floor.
Oh yeah. What's his address? Adam, you're very good at seasonals, and back when I was, maybe 5 years or so into the business, when the last brontosaurus was putting his leg into the tar pit, they used to have a thing called, in commodities, a February break, where seasonally there was a break in commodity prices. They sold off, and that was the break to buy. So another reason why I'm glad to have you with us here. I know we're already a little over a week into February, but could that be a possibility that we get a Fed break and some kind of retracement in gold? The grains have been good. I know we're supposed to be talking about the euro and the pound and the yen, but does your work show the potential for weakness in commodities this month at all?
It's the big turn now is in oil. You have about roughly the oil market works out into 2 6-month periods, and now we're at the start of an upturn in oil and other commodities. And it's a very good month for the Australian dollar, and that speaks to commodities as well. So, yes. And that's just, maybe if you stretch it out to the long term, back to the brontosaurus, it was. But, the seasonals, there's an ebb and flow to it. And now you have a period where this is actually a pretty good time for commodities.
And this is the first time you've had, first time I haven't heard you sound like a raging bear in oil in years.
Well, I was lucky to be on the right side of that trade for over a year, and I still am.
I think there's a possibility for a rally back to 38 to 40 in the crude oil that would still be in the context of a bear market rally. We had that first launch of $7. We've retraced 61.8. I'm not sure if that retracement is done, but a lot of people talking 21 and 17. So isn't the market ripe? Still a lot of people, funds net short the crude oil. Does that prime it for a bear market rally up to those levels?
To me, I think we've had part of it, right? We got 26 up to 34. I think that 35 level is more one I'd look to sell rather than 40. Okay. The storage is so high. We're almost topped out. We have another 3 months of builds and storage, and at some point you have to dump it onto the market, and we get another leg down. And the timing, as always, is the tricky part. And I think 35 balances a risk reward if we get up there again. But right now is the time to probably wait, because I think the dollar weakness is the story here, and how that feeds back in. I mean, it will feed into gold, it will feed into all commodities at some level. But how high can we squeeze the euro? I think dollar yen can probably go down a lot, but the euro, up at 115. It starts to get pretty attractive to sell, and even to hold just dollars or treasuries. The treasury 10 years yielding 173. It seems like pretty good when you get more than Italian 10s.
Okay, so then you're looking for more of an extension of this dollar weakness.
February. We mentioned about seasonal. It's not a great month for seasonal. It's not one where you see some massive trends. We're set up for later in the year, and it's so volatile right now. These things tend to work better in the quieter market, where you can get a little bit of an edge on that. It's the volatility is insane right now.
Yes. Any view on S&P's worst start in market history? January barometer. Saying we're not going to have a great year. Super Bowl indicator, an old AFC team won. Peyton Manning was pulling for the old timer to do it, and we're attacking this 1800 level time and time again. Do you think that the top is in, and how deep could this correction work this year, or is it the beginning of a bear market in equities? I know You've been very sanguine in equities for the first few years. I interviewed you, and correct, and wondering if your view has shifted with this type of dramatic intensity to the downside.
It has, and that's why I'm curious to hear what you have to say, because you've been bearish and I've been bullish, and it's time to have a second look. I mean, when you get 10-year Japanese yields going negative, if you look at the technicals, dollar yen breaking down, it's not good. I mean, the commodity collapse is the story of 2016. The question you have to ask, and you know, and the level for the S&P 500 if we break is 1,500. That to me looks like where it wants to go.
Where's that?
1,500 from 1850 here. Now,
Okay. Yeah. There's
18,
an old double top there at 1550 about.
Yeah, somewhere around. You know, it takes out about half of the rally since 2011. That sort of thing.
I think that was the high in 2000, and then we stalled there in 2006, 7 at the last top, and I think it's also 38% back from the whole rally from 666. So 1550 is an area I've looked at.
And to, you know, to me the question, okay, so we have a commodity collapse. It's going to be at least a mild recession in the commodity exporters. You know, how much worse does it get from there? Are financials holding the bag again? Do they need to be bailed out again? Is maybe China in trouble? You know, a few of these other shoes need to drop, and that's really what I'm watching. Because if it's not, maybe it isn't so bad. You know, even Canada, for instance, big commodity exporter. Well, you know, people have saved a lot over the last 15 years. It's been a great boom. Can Canada ride it out? You know, and just, you know, you're going to have some in the oil exporting part of the country. You're going to have some pain. Commodity in mines as well. But does it hit financials? Does it hit the broader economy, housing? Well, that's the case to get down to 1,500 in stocks, and you know the same sort of thing needs to play out elsewhere. And clearly, the Fed's making a huge mistake, and that's not helping. Central banks have no clue. I keep hearing them talk about China. It's not China. It's the commodities and commodity exporters is the story. With a little bit of China, a little bit of Europe, you know, a little bit of everything. Growth isn't good anywhere, and that's why. You don't have a backstop. You don't have central banks that can really cut rates much.
And I remember at the survey we did at the end of 2016, I'm quoting you, that the Fed, if they moved in March, would be a major mistake. And that was said before we got this big sell-off in equities and a lot of air pockets in the market. So you have to even feel stronger about that now. A lot of the models are saying they're not going to do anything till June of next year.
Yeah, and I think this is a big week. I mean, we're right. Today is a huge day. We're right at the bottom in the S&P 5. I mean, the Nasdaq's already broken. Dollar yen's already broken. This is a massive week, and I think what's happening today is the market is giving Yellen a chance at Humphrey Hawkins to come out and say, "Hey, listen, inflation isn't going to happen. You know, we're wrong about this, that." You know, they don't want to say we're wrong because they just don't say it. They say, "Well, we're going to be data dependent." That to me is the code word. Because when they want to hike, they're not so data dependent, they're forecast dependent. But when they're wrong, they suddenly can look to the data and say, oh, yeah, there's this new data, which means we're wrong and now we're not going to hike. But she needs to be pretty clear, I think, this week, or the market, you know, it'll be like the Bank of Japan. And that's such a strong signal, too, to cut negative like that. And just see it blown up the other way in a week it's shocking, and it's a strong.
Yeah, you know, that rally that you're talking about, we had that rally from 116 to 121 in a heartbeat, and even faster under 116.
Right back and worse, 114 now. The Nikkei, same thing. I mean, if the Fed were to say, okay, we cut back down to zero, surprise in March, stocks rally 5%, and then 2 weeks later they're back down below the lows. I mean, what would that tell you? Would say, my goodness, this market is terrible. The
emperor has no clothes. We've gone from the markets viewing central banks as omnipotent to central banks losing a lot of credibility over the last several months.
It's justified. I have to say, they just don't get that we're at best in this 2% growth era with very low inflation. I mean, you cannot create inflation in the way it used to happen. You can produce things so cheaply and so easily and ramp up production even without adding employees. It's the era of no inflation. So they're just not ready to deal with it because they love their old models. They worked on these models for 100 years.
Well, I'm going to put you on the spot, Adam, because last year you called, maybe we are going to be trendless. But last year you called some of the most dynamic trends alongside the dollar, bullish USD CAD, bearish oil. So, it was good for more than 1 month of your seasonal work. So I know you're a man with a plan, and I'd like to ask you what you're looking ahead towards as I put my Nostradamus glasses on here. I want to hear a NostraButton as to what you're laying back for and what you see as perhaps being some of the better actionable ideas in the first quarter or going forward in the market.
First, a warning. There's going to be a lot of ideas, a lot of talk. For anyone who's listening, they're going to hear a million ideas. Avoid the complicated ideas. There's been so many great ideas that have been ruined by overcomplication. And that's why I'm going to say my best idea right now is the simplest. Pull up the dollar-yen chart, draw a flat line across the bottoms around 115.50. It's broken. Yen's going to be stronger. That means weaker dollar-yen, stronger yen, right across the board. It is probably, maybe you don't want to sell it at 114.87 where we're at right now, but any bounce even up to 115.50 is enough. And probably maybe not dollar yen is the best spot, but yen longs are the trade this year, and gold longs. Again, we broke 1200 yesterday. We break 1205. I think it looks really good. And just keep the technicals simple and go with them, because the headlines, I think right now, you need to be on top of the headlines, but it's dangerous to play those jerky headlines. Good non-farm payrolls headline. That the market.
That's a style change for you.
Friday.
That's a style change for you, Adam, because you're real big on trading these red events.
Yeah.
So this is this is a different. See how marriage can change you. This is a style change for you, keeping it simple, kind of thinking people will buy headlines today, sell newspapers tomorrow. And, if you look at the yen, I guess a simple measured move, if you call 116 the breakdown, would be what, 9 from there, 107, 109 as a possible target. Do you have anything lower than that?
Yeah, I mean, the first one I was looking at was 110, just on the break, 115.50. So but once we get going to the downside, I mean, I guess it depends on the Bank of Japan. I mean, fundamentals do matter, but I think you have to have, you talk about me, you have different tools for different times, and this is a different time. And what matters is the big levels, the big breaks. The breaks are going to break, and they're going to go the same way that dollar CAD did from 134. But you gotta, and it, I read some good stuff. How do you know when you're wrong? Well, when you're wrong, you get stopped out. I mean, Goldman Sachs today talking about getting stopped out of dollar longs. Well, you get stopped out and you move to the sidelines and you take another shot. Put together a case, the technicals, the fundamentals, whatever you can. Try to get a good level and try to stay in. But
how about USD CAD, Adam? Perhaps it remains under pressure. While we're getting this little bounce in crude up to 35, but do you think new highs are in order? We pulled back about 1,100 pips from the recent high. Could you foresee new highs in USD CAD?
I can. Not now, though. I think we really need to sort out what's happening in the Canadian economy first. I mean, I think oil is going to 20, below 20. So it's inevitable that the dollar CAD will go higher. But right now the dollar's getting flushed out a little bit. You get some technical corrections. Maybe you get down to 134 is probably 134, 135 is the spot for me to buy. It's impressive today even. I mean, dollar CAD is way down today, cent down, and oil's basically flat. I guess it's a little bit higher now, but it was flat when we started. That's impressive the way the Canadian dollar has rallied the last 2 weeks without really that much support from oil. And so get out of the way of that. But Canadian employment data on Friday was the first real indicator that there's some weakness. However, export numbers were good. And I think, what's really priced into the Canadian economy right now? So we know oil's bad. We know that part of the country's going to be weak. But I think we've priced in a lot worse. We priced in the Bank of Canada cutting a couple times, maybe even going negative. We priced in, big trouble in the Canadian economy as a whole, barely any growth this year. We priced in the possibility of a housing downturn, major housing downturn. So we priced in like 2.5 strikes against the Canadian economy, when the numbers have shown us only like one strike in jobs data. So we need a little bit of confirmation that something bad is happening, and maybe we've gotten a little bit.
We've already priced in a recession there.
Yeah, that's right, and so that's a dangerous spot to short a currency when a recession's already priced in.
I just have a couple of more instruments. You being an oil trader, you pay attention to the natural gas, and is that a different animal, or is that going to continue to trade in tandem with oil? Any view?
Yeah, I think it's a different animal for sure. I mean, what happened in natural gas, or what's happening in oil now, happened in natural gas 10 years ago when they were producing everything everywhere. It was flooding the market. We were up at 14. Chesapeake yesterday, that was telling, right? They're the second biggest natural gas producer in the United States. The market believed they were bankrupt, or believed they could be bankrupt, that tells a lot about the market, which rumors they will believe, right? There's always going to be rumors. But if I were to tell you, there's a rumor that Apple's bankrupt, well, you know what? Nobody's selling their Apple shares on that, right? Because it's unbelievable. But you say it about Chesapeake and shares fall 50%. It's an insight into the psychology of the market.
I would check to see if my iPhone was still working.
Yeah.
So I wanted to also ask you your constructive on gold, and I'm an old commodity guy, and I used to trade the gold-silver ratio, and I'm wondering if you have a view on silver and the potential of silver to outperform gold, or will gold do it basically because it's more of a monetary metal, and silver has an industrial use. Mainly, they use a lot of silver in solar panels as we go green. Wondering if you had a view on the ratio between gold and silver.
I have a strong view. It's funny, especially in Canada here, there's a cottage industry around these silver bulls and this ratio, and I don't think it matters at all, those ratios. I mean, if you want a precious metal, if you're a central banker, if you're anyone, you buy gold. Gold is, silver kind of gets tagged along with gold. I don't know if it's like an Olympic thing or a historical thing, or they used to store silver in Spain in the vaults for the King of Spain. But silver isn't gold. It's not the same kind of monetary instrument. It really isn't. And the production's a different sort. It's easier to get out of the ground. The mines operate differently. And I don't think that ratio means anything. I really believe that it's a sucker's bet on silver. If you think these factors add up, buy gold. Silver is, to me, not the same thing, and I just think it's been overstated and overplayed, and people have been burned hard on that trade for the last number of years. Yeah, the industrial side is a different story, but then it's just like every other commodity, silver, right? It's one or the other. And I don't like silver for that sense. I just again, it's that simple trade I said earlier. If you like it, buy gold.
Okay, and do you think that part of the move behind gold is that there could be a stage to where, if there's any kind of currency realignment or revaluation, that gold might be part of another reserve currency down the road? I know that's really speculative, but I've been reading a lot and have interviewed some fundamentalists that were negative on gold, that they've moved the euro fix closer to the precious metal fix every day. Our central bankers eyeing that as a possibility if the dollar falls, if the dollar does lose its reign as a reserve currency.
Where we're at with central banks, it's like I said before, central banks like what they know. They like this system, the old system, the pre-crisis system. They're very comfortable in that, and they want to stick with that. And the gold, there's really not enough supply to make it a meaningful monetary instrument. Now, that said, I mean, Donald Trump is the kind of guy that could come out and talk about that, and you know, there's a chance he wins the election, probably a growing chance all the time, and that kind of headline could send gold up $200. It's
Yeah.
so, you know, the idea I think has a chance to help gold. In reality, I don't believe it will happen. The fiat currency era isn't coming to an end in my lifetime, I don't believe, but that doesn't mean that gold still can't be a great trade for
Okay.
many other reasons. The volatility alone in currencies is
Well, how about this, Adam? Is there a possibility, especially if the dollar regains its footing and breaks out over the par level and starts trading 105, 102, 107, some of the targets that long-term dollar bulls have, that there's a shot for a Plaza Accord 2.0, because you said the story is a collapsing commodity market, and one cure may be and giving relief to emerging markets would be a Plaza Accord 2.0, where all the central banks in the world get together and take the dollar down through direct intervention, like they did in '85.
and it would have to be some sort of realignment at the same time. I think the first step, maybe I think that's 3 or 5 years away, because I think a lot of this pain in emerging markets like Brazil is going to last that long, and they will be desperate by that point. But now I don't think there's been enough pain to get there. The story is going to be China first and what they do with yuan. It's bizarre that they're so sensitive about this criticism of their currency being strong, and they're also, they're acting to keep the currency strong. They spent $100 billion last month to prop up the yuan, and they, that will run out. How much of their FX reserves do they want to spend to keep it? Why not just let it get weak? They're so obsessed with stability that they can't allow the yuan to weaken unless it's sort of them guiding it. They can't have free markets and have control at the same time, same as the stock market there. So that is kind of, I think the Plaza Accord that matters is within Beijing. Their kind of own currency regime is what matters, and that can throw the whole thing into disarray. And it might be what, if they just open up and give up, well, then maybe there's this flood into the US dollar and it just screws everything up, and it just sloshes around for 3 or 5 years, and then something needs to be done at that point.
Okay, Adam. Well, I want to tell you that I'm enjoying wearing the Mario Draghi T-shirt. Yohei sported it at one of our live events, so great marketing idea. And I ask people, I say, most people that aren't in the industry have no idea who's playing that guitar, so it gives me a chance to explain to people what I do when I wear that.
I know you love the rock and roll, Dale. So
I do, buddy, and every time you're here, we rock, Adam. I think we've covered the whole universe here today, and I want to thank you for your time. I recommend that people go to Forex Live. I know you do a lot of great educational material, you and Greg and your other associates, and anything you want to tell the community or people that view this on the recording later, what Forex Live is doing to help build up and edify traders every day, because I know that's your mission, just like mine.
Yeah, that's right. There's a free Forex portal that we talk about what's going in the market in real time. We update on by the minute on news, analysis, market moves, and we keep it absolutely live. And it's just a place to talk about the market, and we're just having a lot of fun for some days, at least.
Well, thank you, Adam. You could follow Adam at Forex Live, at FX_button, and go to the website www.forexlive.com for great content from Adam and Greg and the whole team. And thank you so much. Great chat with you today again, Adam. I hope this is a great year for you and your new start and your new life, and that pips rain down on you and your family forever. How about that? That's a long time. Forever.
That's it. I like the sound of that. It was great chat today, and I'll tune in tomorrow and the next day to see what you're thinking about stocks, because I'm really curious to see which way this goes this week.
Okay, well, just One thing that surprised me about this decline, I was long a lot of VIX products, and the fact that the VIX has not really kept pace with the intensity of the decline is either the VIX is broken or the VIX is saying that there's some type of counter trend rally developing that is going to take the shorts by surprise. My best guess is that we bottom in here sometime this week and we have a recovery into April. And that would be a better shorting opportunity for me. 2-year targets.
I like it. Okay, thanks, Joe.
Those are my calls. The next one's yours. Call 800-899-BEAR. Ride the wave with Pinker Commodities. That was my old my old gig many years ago when I was a young man like you. So thanks again, Adam. Great to be with you, and good hunting, my trading warrior brother.